Hello and welcome. In this lecture video, I'm going to be talking about issuing bonds at par value, issuing bonds at a discount, and issuing bonds at a premium. Okay, so when we issue bonds at par, that means the company is going to issue their bonds. They will receive the par value of their bonds. So remember, par value is how much the company is going to have to pay back at the maturity date. So if they have to pay back $1,000 in 5 years from now, issuing bonds at par means basically that they get $1,000 now, and then they pay back $1,000 in 5 years from now. Remember that they still have to make those periodic interest payments as well. Recall that when we issue bonds, we incur two obligations. The first one is to pay back the par value. The second one is to make periodic interest payments. Okay, so getting back to issuing bonds at par, when we issue them at par, that means the company is going to receive right now in cash. They'll receive the par value in cash, and then they'll pay back that par value at the maturity date. So let's look at this problem. Suppose a company receives authorization to issue $800,000, that's the par value, of 9%, that is the contract rate, on an annual basis. That is the contract rate on an annual basis. 20-year bonds, so this means that they'll mature on December 31st, 2030, which is 20 years later. Okay, this is the maturity date. The bonds pay interest semi-annually, so every 6 months, on June 30th and June 31st. Prepare the journal entry to issue the bonds. So when we issue these bonds, we're the company that issued these bonds, and so when we do so, what do we get? We get $800,000 in cash, and we're getting the par value right now up front in cash, and then in 20 years we have to pay back $800,000. That's what this is telling you. Also, we have to make these semi-annual interest payments. So we get cash now. So we're going to come over here, we're going to debit cash. Remember our accounting equation up here. We have our debit, we have our credit, and then we have our credit, and then we have our debit. Debits increase assets, credits decrease assets, credits increase liability in all equity accounts, debits decrease liabilities in equity accounts. Okay? And remember, equity has 4 components: revenues, increase equity, expenses, decrease equity, withdrawals, owner withdrawals, decrease equity, and then finally owner capital or owner investment increases equity. Okay? So when we look at this journal entry to issue the bonds, we can think about this in terms of our accounting equation. Where do we put cash? We're getting cash. That's what happens when I issue bonds. It's like you taking out student loans. What do you get now? You get cash to make your tuition payments and pay for your living expenses, so on and so forth. So we get cash right now. Where do we put cash in terms of the accounting equation? Cash is an asset. How do we increase an asset? With a debit. So we debit cash for $800,000. And then what do we incur? Remember, bonds, as I said in the first lecture video, that is a liability. Bonds are a liability. Where do we put liabilities? Right here, in terms of the accounting equation. How do I increase a liability? With a credit. So the liability, the specific liability that I will credit, is called bonds payable, $800,000. Debit cash, credit bonds payable. This is the journal entry to issue bonds at par. This is the journal entry to issue bonds at par. Okay, this is a liability, long-term liability on the classified balance sheet. It's an asset on the balance sheet. Okay, so in terms of how does this journal entry keep our accounting equation in balance? Assets go up by $800,000. liabilities also go up by $800,000. So now let's look at the journal entry to prepare the first semi-annual interest payment. Okay, so our first semi-annual interest payment, remember, if we look over here, I'll put this page back. The way that we calculate, as I said this in the first lecture video, the way that we calculate how much interest we have to pay our bondholders, the way we do this is par value times contract rate. What's the par value? What's the contract rate? So $800,000 times 0.09. Here's the problem. This is on an annual basis. My interest is being paid on a semi-annual basis. So I have to multiply the par value times 0.045, which is half of my annual interest rate. So basically what I need to do, because this is on a semi-annual basis, I have to adjust my annual interest rate for semi-annual, which means divide it by 2. And if it were quarterly, divide it by 4. In this case, it's semi-annual, so divide it by 2 because it's every 6 months. 9 divided by 2 is 4.5. So $800,000 times 0.045 is how much interest I will pay my bondholders. That's how I figure that out. So I'll write that down. 800,000 times 0.045, which equals our $36,000. Okay, so now we can do our journal entry. And how do we do our journal entry? We're going to debit an expense. Okay, this interest payment that we have to make to our bondholders is called bond interest expense. And if we look back over here on this prior page where we showed the accounting equation, expenses are recognized with a debit. Remember that from Accounting 101. Expenses are recognized with a debit. So as expenses go up, I debit the expense to recognize the expenses going up. Why do I do that? Expenses decrease equity. How do I decrease equity? With a debit. So I will debit bond interest expense. Debit to bond interest expense for $36,000. And I'm going to have to draw a line over here to separate that out. Debit to bond interest expense for $36,000. Then what do I credit? Well, I'm making a cash payment. So if we think back over here in terms of our accounting equation, equity is going down because I debited bond interest expense. Expenses, that means when I debit bond interest expense, expenses are going up, equity is going down. What do I pay the interest expense with? Cash. Cash, therefore, I don't have as much cash because I'm paying it to my bondholders. Cash is an asset, so cash is going down. How do I recognize that an asset is going down? With a credit. Okay, so then I will credit cash for $36,000. Debit bond interest expense, credit cash, $36,000. As I say right here, this journal entry is going to be made until the bond matures. Okay? So recall that when we issue the bond, we're going to say here's our par value, the maturity date of the bond. We have to say what the maturity date is of the bond. We need to say what the par value is of the bond. But we also need to say what our contract rate is. And as we saw in this problem, our contract rate was 9%. A contract rate is also called the stated rate, coupon rate, the nominal rate. Okay? As I was saying, that's stated on an annual basis, even if it's paid semi-annually. And as I was saying this earlier, contract rate times par value is the amount of interest that we have to pay. That contract rate, though, is different than the market rate. Okay? What is the market rate? It's the rate that borrowers are willing to pay and lenders are willing to accept for a certain bond. That is determined by the supply and demand for credit. So what we have over here is we have market rates of interest. And those market rates of interest could fluctuate pretty frequently. What things could cause changes in market rates of interest? The Federal Reserve increases or lowers interest rates. Other macroeconomic conditions, maybe how well the company is doing. If the company is not doing well and they already have a lot of debt and they're trying to issue more debt, what do you think that would mean for the interest rate that they have to pay? They're going to have to pay a higher interest rate. Why? Because they're more risky. They already have a lot of debt. So anybody who buys those bonds is going to say, well, how do I know for sure you're going to be able to pay me back? I'm going to require a higher rate of return. Okay? So supply and demand for credit influences the market rate of interest. Okay? The thing is that when companies get authorization to issue their bonds, they try their best to align the contract rate, which is stated on the contract. That's how much they have to pay on an annual basis. Contract rate times par value. They try to align the contract rate with the market rate of interest for their particular bond. Okay? The problem is, as I was saying earlier, is that the market rate may fluctuate. Market rates fluctuate based upon macroeconomic conditions, the Federal Reserve, all kinds of different issues can influence the market rate. So there's a time gap between when a company specifies its contract rate. There's a time gap between when the company specifies its contract rate, right, which is when they get authorization to issue the bonds, and then the time that they issue the bonds. So there's a time gap. And in that time gap, market rates could change. So it is possible that even though a company tries its best to align the contract rate with the market rate, there could be differences between the contract rate and the market rate simply because market rates have changed, perhaps because macroeconomic conditions have changed. Okay? Can't change the contract rate. You already got authorization. Investors can't change it, and bond issuers don't want to change it because they already got authorization. So can't change the contract rate. Market rates are always changing. But if the contract rate is 9%, let's say the contract rate is 9%, it can't be changed, but macroeconomic conditions have changed, and now bonds with similar risk profiles to the one that you want to issue, the rates of return are now 10%. So other companies that are getting ready to issue their bonds similar to yours, they're paying 10%. You only pay 9%. You are paying less than the market. What do investors do? They say, I'm not going to pay full price for your bonds. They say, I'm not going to pay full price. I'm not going to give you par value for your bonds. That's what they say. So in that case, the bonds would be issued at a discount. On the other hand, if you are saying, well, you know what, I specified my contract rate when I got authorization to issue the bonds, 9%. Macroeconomic conditions have changed, and other companies that are issuing bonds similar to yours, they only pay 8%. You pay 9%. Companies with similar risk profiles that are issuing bonds similar to yours pay 8%. You're paying more than the market. What does that mean? Investors want to buy your bonds. When investors want to buy your bonds, what happens to the price of your bonds? They go up. So in that situation, you can issue your bonds at a premium, which means you will get more cash than the par value. So we can summarize by saying, if the contract rate is less than the market rate, you're going to issue your bonds at a discount. You will get less than par value. If the contract rate is more than the market rate, you'll issue your bonds at a premium. You will get, right now when you issue your bonds, you will get more than the par value. If the contract rate is equal to the market rate, you issue your bonds at par. Okay? And that's what I'm saying right down here. Okay, so in the next lecture video, we'll do some quick check problems and some journal entries. Thanks.